but
We don't have to go to dinner tonight? Good afternoon. I call to order the work session of the Board of Regents. I would note that we have approximately 90 minutes allocated for this work session. With us here today, and he'll be coming up to the podium or the horseshoe here, is Chief Investment Officer Andrew Parks to provide us with an Endowment 101 lesson. And he will be joined by Associate Secretary Jason Langworthy, who will assist in walking through the policy framework and history of the university's centrally held endowment later in the presentation. With that, Chief Investment Officer Parks, would you like to start?
Thank you, Chair Mayeron and members of the board. Appreciate the opportunity to be here today and facilitate this working session on the endowment. For the, I think, quarter of you who have sat in on our investment committee meetings in the past, you know that I'm not known for my brevity, so it's probably a good thing that we have 90 minutes set aside for the topic. But
Okay.
as you'll see on the presentation outline, the way that Associate Board Secretary Langworthy and I set up the presentation outline is to basically split up the discussion into two topics. So the first is, as Chair Mayeron mentioned, a review of the endowment at kind of a one-on-one level. So we'll talk about the objectives, the risks and constraints, where the money's come from, how it gets spent, the investment strategy, and performance. And then the second section is going to be talking about the principles that really are overarching and that govern those activities. One caveat that I want to mention before we get started is I recognize that among the board members, there's likely a broad range of degrees of understanding and sophistication with some of these investment and governance topics that we'll be discussing. So my plan and intent is to keep it relatively high level, but certainly welcome more detailed questions during the Q&A session at the end. So with that, what I'd like to do at the outset here is just to foreshadow some of the key takeaways from each of these two sections, so you can keep those in the front of your minds as we walk through the presentation. So first off, regarding the endowment, at its most basic, an endowment is a pool of financial capital that exists to support the institution, ideally into perpetuity. A typical endowment, referred to as a true endowment, means that the corpus or the principal that went into funding that endowment is never to be spent, but the earnings or the proceeds on that are distributed each year to support the core mission. In our case, the vast majority of those payouts go to support research, endowed chairs, scholarships, fellowships, et cetera. And because an endowment's time horizon is so long-term, effectively going into perpetuity, the investment strategy allows us to take a lot of risk. And the way that we think about risk is there's ability to take risk, which is more structural, and then there's willingness to take risk, which is more philosophical. And if we look at the board policy, if we look at the investment philosophy of our team and the investment committee, we have the willingness to take a lot of risk, and we've used that mainly by structuring the portfolio to be very equity-centric, meaning we invest predominantly in stocks more so than bonds, and our focus is on the private markets as opposed to the public markets, where we think the potential for upside is more significant. I'm also going to walk through the order of operations, so to speak, of how we go from a high-level strategy to a portfolio that ultimately has exposure to 10,000 plus companies. In short, the chronology is we select asset classes, then we select regions or geographies, then we select strategies, and then finally we select fund managers, so expert third-party institutional quality managers who are ultimately the ones who obtain exposure to the companies that we have in the portfolio. And lastly, on performance, the performance has been very strong over the past decade. We've compounded it over 10%, which is far in excess of the return objective that the board has set for us, which is inflation plus 5%, and well in excess of what we would have returned had we just invested passively in a globally diversified mix of stocks and bonds. Now, similarly, I want to provide the takeaways about the governance model and the mission-aligned framework that we employ when implementing the strategy that I just alluded to. So first, the board policy that governs these activities at a high level is called the endowment fund policy. You all just approved some revisions to that last year. That policy lays out the objectives, the asset class targets, the liquidity constraints, how much we can have in hard to sell assets that are illiquid versus easier to sell assets that are liquid. And it's also included some language more recently about the integration of environmental, social, and governance, or ESG-related principles, which we've described as being aligned with an ESG-aware framework. And in short, that means while we try to make money, we're trying to make money while doing good, but importantly, we do not sacrifice on financial returns in order to align with ESG considerations. Now, while the language just was codified into board policy a year ago, it's worth pointing out that we've been effectively managing the program largely in line with the spirit of this policy for many years, and we're proud of our track record. And I'll walk through some examples of what we've done to invest in the energy transition, to proactively source and partner with emerging minority and women-owned funds, et cetera. Then we'll talk about some industry trends. Specifically, I'll reference NACUBA, which I assume many of you are familiar with, is the National Association of College and University Business Officers. They conducted a survey last year of 688 colleges and universities looking at their behavior with respect to whether to incorporate environmental, social, and governance, and if so, how so. And what we found is about 2/3 of them do not incorporate these concepts really at all. Only about 1/4 of them have codified them into policy. And we're going to talk about some of the reasons for why that is. There are, I would say I ascribe to the adage that there aren't solutions, there are just trade-offs. And so we're going to walk through what some of the trade-offs are around incorporating some of these concepts. But as listed here, they can involve return give up, cost impacts, some operational complexities, and a few others. And then lastly, Associate Board Secretary Laneworthy is going to walk through a history of precedent actions that either the board or the administration has taken specifically regarding divestment with a look back of about 5 decades. So with that, let's get started on the endowment 101 section. So after understanding that endowment is a pool of financial capital that exists to support an institution's financial needs into perpetuity, the next important thing to understand is that pool of capital's specific objectives. And so what's laid out here is the endowment fund policy. And the marching orders that we have from you all in simpleton's English is, over the long term, don't lose money. Instead, make money on an inflation-adjusted basis at a rate that's greater than we pay out. Make sure that those payouts are stable and take smart risks in doing so. Now, implicit in these goals is the overarching principle of promoting what's referred to as intergenerational neutrality. So this is the concept that on an inflation-adjusted basis, you want the payouts from the endowment to support current generations in a proportionate manner to the future generations. And that is accomplished if you're able to generate returns that meet that payout rate, ideally exceed it. If you think about what would happen if your payout rate is higher than that, that means you're benefiting current generations, but you're running the risk of running out of capital to support future generations, and vice versa. If the payout rate is too low, that money is staying in the endowment and compounding to the benefit of future generations, potentially at the expense of current. So the idea is to find that sweet spot, and that's really what is implied by the language that you all have included in board policy. Now, the university centrally held endowment is internally referred to as CEF, or the Consolidated Endowment Fund. As you'll see today, the value is just shy of $2.3 billion. Again, the return objective is inflation plus 5%. So nominally, think of that as an 8% roughly return hurdle. And the payout rate is 4.5%. But for reasons I'll describe in a minute, it's important that 4.5% is actually smoothed out over a 5-year period. And then lastly, the payout reflects about 2% or comprises about 2% of the university's operating budget, which translates into about $90 million per year. That $90 million just reflects the quarterly income distribution. There's also episodically some withdrawals of principal, which add another 15 to 20 million on average a year. So ballpark, I would think of the impact of the endowment's payouts as being roughly 100 to 110 million a year. Now, this slide, which apparently looks a lot different than I intended it to. Apologies for that. what I intended to have the slide do was provide a bit of a window into where the money has come from, the types of endowments that we have, and the uses of that capital. First, in terms of where the money has come from, the bulk of it is associated with what is referred to as PUF, which is the Permanent University Fund. So that's capital that has come in from the state due to iron ore taxes, royalties, land grants, et cetera. Another quarter of it has come from donors, and so those are donors who have contributed to the university prior to the formation of the foundation back in 1962. Any subsequent donations that have come in go directly to them. And then another 20% is associated with royalties or department income. A good example of that would be proceeds from an HIV drug that Dr. Vince in the Center of Drug Design developed back in the 90s that was commercialized by Glaxo and brought in something like $600 million to the university. A good chunk of that went into the endowment. Importantly, state appropriations, tuition, and other miscellaneous sources cannot be used to fund an endowment. Now, I mentioned that it's referred to as the Consolidated Endowment Fund, and I think that's an apt term because the endowment, while it's one pool of capital, it's actually made up or comprised of over 1,500 individual endowments. And at a high level, we can differentiate among those endowments by putting them into one of three categories. So it's either a true endowment, which means that the principal or the corpus of that can never be withdrawn. There are quasi-restricted endowments, which means they can be drawn if the corpus can be drawn if certain conditions are met. And lastly, there's quasi-unrestricted, which means there are very few strings involved. And so when you add up what I'm looking at on my page, which is going to be indiscernible on yours, but it's about 2/3 of that capital is associated with either true or quasi-restricted endowments, meaning that that capital is quite sticky. And then lastly, in terms of the uses, as I said, over 80% of the payout goes to support the university's core mission. So we included here the breakdown by research, by endowed chairs, scholarships, fellowships, et cetera. And over the last decade, approximately $632 million has been paid out just from the quarterly distributions. Now, we've established that there's a high return hurdle at inflation plus 5%. The capital that's in the endowment is relatively sticky. The payout rate is smoothed and reflects a relatively small portion of the operating budget. So putting this all together, as I said earlier, we have a high ability to take risk. Now, the only thing that's working against us a little bit is that we don't get much in terms of new inflows to the endowment, which reduces our ability to take risk. The reason being, every year to fund our payouts, we need to find liquidity for about 5% of the fund. If we knew we had money coming in, we wouldn't then have to go ahead and create those liquidations, which would allow us to take on a little bit more risk. But in whole, we have a high risk tolerance, which really heavily informs our thinking on the investment strategy, which I'll outline here in a second. However, one thing I wanted to do is just elaborate a little bit more on the smooth payout formula that you all have codified in board policy. And so, as I mentioned earlier, one of the objectives outlined in board policy is to provide stable distributions for annual spending purposes. And achieving that objective of stable distributions could arguably be achieved by aiming to have very stable returns. But as you can probably guess, having very stable returns and not accepting some risk or volatility often means you're giving some upside potential up. And so I would say that your board policy provides a more elegant solution and gives us the best of both worlds, and that the payout rate is codified as 4.5% based on a 60-month average. And so by taking that average upon which that 4.5% is calculated, what we're automatically doing is smoothing out what would otherwise be a volatile payout profile. So what you see on the left-hand side here in the maroon line is our one-year return each year for the last decade. And you see it's all over the place. So there are times where we're up 20, there are times where we're flat, but it's quite volatile. But what's interesting is if you smooth that out over 5 years, it ends up actually creating the distribution profile you see on the right. And that is nice and steady and up and to the right with a growth rate of a little shy of 7%. So as you'll see in the bottom, that payout rate formula really acts as a shock absorber to smooth out what might otherwise be a bumpy ride. So I mention it just because it might appear as an inconsequential detail in board policy, but it does have a real impact on both on how we invest and on the beneficiaries of the payouts. Now I want to transition to talk a little bit about the investment strategy itself. And so A logical first question you would ask if you're developing an investment strategy would be, what would happen if I just invested passively in a diversified mix of stocks and bonds? Would that be sufficient to achieve our objectives? And what this chart shows in the gold line is our target returns. That's inflation plus 5%. And the maroon line shows what the market would have given us over this past decade had we just invested passively. And you'll see that there are times where it's sufficient, times where it isn't. If we look today at where interest rates are, where valuations are, our estimate would be that that kind of portfolio would generate somewhere in the 6 to 7% range, but that's well short of the 8 to 9% that we need to generate in order to meet the objectives that you've set out for us. And so our challenge and what we spend most of our time thinking about is what can we do other than invest passively in the markets to try to make up for that shortfall. Now, the answer to that question touches on some more advanced topics around beliefs on market efficiency and investment strategy and tactics. But at a high level, our strategy is to pull multiple levers in an attempt to create multiple ways to win. So as you'll see here, we reject the idea of just accepting low returns. We don't try to market time. We don't think that's a core competency. We're not trying to overly concentrate or just take on a lot of additional risk. The goal is to take smarter risks and invest heavily in markets that we think can outperform. So the formula is to find a handful of different sources of premiums, which in our world means excess returns that can be generated by, for example, investing in innovative startups that at earlier stages that we think can deliver significant upside potential, or investing in strategies where there's better alignment of interest. Charlie Munger, who was Warren Buffett's number 2 for many decades, would say that, show me an incentive and I'll show you an outcome. And I think that's an adage that's very apropos in the investment industry. We look at investing in markets where you can get paid extra for complexity or for locking up our capital into illiquid structures. And so hopefully by picking the right strategies and implementing with top-tier managers, we can, as I said, create multiple ways to win and close that gap between what the market can give us for investing passively and what we need to generate in order to meet our objectives. Now, those principles are embedded in the asset allocation framework that you see here, which is codified in board policy. The bulk of the portfolio is an equity-oriented or growth assets with a range of 55 to 75%, the target being 65. We have 20 to 40% in non-equity strategies, which we call diversifiers. So those are credit funds, hedge funds, real estate, et cetera. And then the last bucket we call stability, which just provides programmatic liquidity needs and has a target of 5%. Importantly, underpinning all of this is the first bullet point, which is our focus on the long term. And we align our investment strategy due to the fact that our capital is long term, the goal of supporting the university is long term, and so we focus more on what we say is the destination more so than the journey. So it could be bumpy along the way, it could take us a long time to get there, but as long as the destination allows us to achieve the objective, we're less worried about how challenging the journey might be. Now, I mentioned that we like to spend most of our time in the private markets, mainly venture capital and private equity. Those two strategies today comprise about half of the endowment. There are many reasons for this, but the one that I want to point to on this slide is the upside potential. So what this visual shows is in the median return, it's the orange diamond here, of each asset class over the last 10 years. So stocks, bonds, real estate, private equity, venture, and hedge funds. And the gray bar represents the return of the top quartile fund in that sector or that asset class, and the bottom part of that gray bar represents the bottom quartile fund. And so what you see is that the median funds for private equity and venture tend to outperform traditional public equity and certainly bonds. But importantly, if you're in a top quartile fund, there's a significant amount of outperformance. So we talk here about return on time. And the reason why we spend a lot of our time in private equity and venture is if you get the manager selection process right, you can be rewarded for it. Whereas in the public markets, the difference between top and bottom quartile is only a couple percent, whereas in the private markets, it's closer to 20%. Now, that is simple to say. It's much harder to execute, but that's what our team spends most of our time on. Now, I thought it might be instructive to just highlight some of the differences between investing in the public markets and the private markets by offering up a brief metaphor. So think of public market investing like a baker baking a cake, and private market investing like a vintner or a wine grower growing grapes and making wine. And what I mean by that is baking a cake has a very short feedback cycle. So you get your ingredients, you mix them up, you throw it in the oven. 2 hours later, you know whether you have a good cake. That's like investing in the public markets, where every day you can see the price of your investment. It goes up or down. Obviously, you want to focus on the long term. But the point is that in those markets, you always have a short and pretty immediate feedback cycle. In contrast, private investing is a lot more like a vintner with a longer feedback cycle. So vines take 3 to 5 years to be suitable for harvesting. Then you need to harvest them and press them and ferment, and then there's the aging or the cellaring process, and it takes in many cases years for that bottle of wine to mature in the bottle. And likewise in the private markets, we plant seeds, but they take a long time before they're ready for harvest. So in venture capital, usually these are early stage companies that might take a decade before they could be sold. In private equity, it's usually 5 to 7 years. And so in practice, we're planting seeds every year with the long term in mind, and in a more mature and established program like the one we have, what we like to see is a balance across planting new seeds, letting them grow, and ultimately harvesting. And so what you see here is about a third of the portfolio is akin to the baker, where I mentioned that's our public market exposure. We can move that around any day if we wanted to. Whereas about 2/3 of it is in semi-liquid or more illiquid strategies. More than half of the fund today is in investments that were made or committed to more than 4 years ago. A quarter of the fund is in investments that were made or committed to more than 8 years ago. And so successfully executing this strategy is really about time and patience and consistency of planting new seeds and the recognition that we won't ultimately know how many of these strategies play out for quite some time. But as the prior slide shows, if you get it right, investing in these markets can be quite fruitful. Now, I want to switch a little bit to talk less about high-level strategy and more about how we think about implementation. And so I mentioned earlier that the chronology of decision-making is we pick asset classes, then we pick geographies, then we pick strategies, then we pick fund managers, and it's ultimately the fund managers who select those companies. And so just to give a case study to that, about 7 years ago, we invested $50 million into the iShares Low Carbon ETF. So we actually seeded this fund, meaning we provided the initial capital for it alongside the United Nations, and it's a fund that reduces the carbon footprint intensity relative to the traditional index by more than 80%. But let me describe how we got to that $50 million number. So we said we want to have, first on the asset class side, about 20 to 25% of our portfolio in public equities. Of that percentage, we want to have a certain portion of it that is globally diversified across these 50 to 70 countries. Then we made a decision of how much we wanted to have in active strategies, which are intended to beat a benchmark, versus passive strategies that are intended to largely replicate it and get broad-based exposure. Specifically, though, we like this strategy of being ESG aligned and finding ways to tilt toward the companies that were best in class in their countries and sectors and vice versa. And so that's ultimately what led us to this investment of $50 million. And after we made the investment in the fund, they've gone ahead and purchased exposures to 1,200 some companies in, I think it's 51 countries, if I remember correctly. So in total, you can see we have exposure to 6 asset classes, 71 different countries, 40 different strategies, over 100 managers. So we were hopeful that this would be this mosaic view into how we thought about portfolio construction. But hopefully it's just clear that our team is not sitting around saying, let's put $1 million into 3M and $2 million into Target and $3 million in United Health Group, right? These are results that really reflect a lot of other preceding forks in the road. Now, another key point to understand is that given we're gaining this exposure to these 10,000 plus companies predominantly through funds, that means that our exposure to these companies is considered indirect. So what I mean by that is that you'll see on the right-hand side, the stocks and bonds are purchased by a fund. That is 98.3% of what we do. So that means that fund manager has ownership and control over that stock. They get to vote the proxies for that stock. They receive the dividends on that stock. and they have control of the trading activity. So a simple example is if we decide to invest $50 million in a large cap US fund, that manager decides to buy 50 stocks. Perhaps Apple is one of them. If they buy $1 million of Apple, that holding is indirect. In contrast, direct holdings are positions that we buy directly, either in the private markets or on exchanges in the public markets. These positions only account for 1.7% of the endowment, and I can elaborate later if it's of interest how or why we do this, but suffice it to say it's not a meaningful portion of the portfolio. But you'll see in those situations, we do have ownership and control of that position. We do get to vote proxies. We do receive the dividends directly. So if we went and bought $1 million of Apple in the public markets, that would be considered a direct holding. Now, with this information fresh in our minds, what I want to do is just go down a brief tangent and talk about the relevance of this as it relates specifically to the topic of divestment, which we'll discuss more in the next section. But the key point to be aware of is that because of this implementation approach, because we invest through funds, if we were to divest of a handful of companies, we would have to effect that by selling out of the funds that house these companies. We don't have an easy mechanism to simply sell individual companies. And so for the sake of illustration, I just want to share a real but arbitrary example. And so I asked our team yesterday to run the data to see what we would have to do to divest of all companies that have the letter J in their name. So very arbitrary. My thought was we probably don't have a lot of J's in the portfolio. It occurred to me afterwards that it happens to be the first initial of the chair's first name, so apologies for the oversight. But,
Happy to be sold off.
I guess apologies. But the point is that we have about 3.5% of the entire endowment is invested in companies that have a J in their name. Now, if we were to divest of all of those holdings, which is about $80 million, we would have to sell 40% of the fund. So roughly $900 million just to divest of those companies that start with a J. So that's an 11-to-1 ratio. That means we have to sell $11 of fund exposure just to get rid of the $1 of J exposure that we want to divest from. Now, simply put, implementing a divestment mandate has two components. First is selling in the present that which you own but don't want to. The second is implementing what we'll talk about later, which are basically negative screening protocols to prevent that exposure from getting into the portfolio in the future. So in addition to the 40% that we would have to sell, there would be another 10% that we would have to switch from other strategies into custom mandates that would allow us to ensure that that J position does not get into our portfolio in the future. Now, this is getting into the weeds a little bit, but the mechanism through which we would implement that is effectively a hybrid structure between this indirect and direct holding. So I would say it would be akin to if you have a Fidelity or an E-Trade account for your own personal retirement or savings account, and you decide, I want to hire a financial planner to manage this on my behalf, or a financially savvy brother-in-law, you give them access to your account. You still own that account. You still can decide what happens. It's still your money. However, an outside professional is managing on your behalf. That is what we would have to do if we wanted to implement this type of strategy. And so, point being, if we wanted to get rid of 3.5% of our fund, we'd have to pretty much impact half of the fund. And what we'll talk about later on, as I said earlier as well, is that there aren't necessarily solutions. There are just trade-offs. This would be the trade-off in this case. It would impact not just cost, because these strategies are more expensive to run. It could impact return, because you would be selling out of strategies that you can't control what they do, but might otherwise provide excess return. And there's certainly some operational complexities. So I thought that even though we hadn't quite dove into any of those topics yet, I thought it would be helpful just while we were on the topic to highlight that. Now, oh boy, this didn't turn out the way I thought it would, but the chart looks great on my page, but
it also looks fine in our docket material.
Right.
no, okay.
I was going to say, if people want to refer to their own docket materials, you'll get these charts in the
works.
way that Andrew intended them.
No, that's fine. So the last part of this endowment 101 section is just a discussion on performance. I don't want to take up too much time on this topic, but in short, performance has been really strong this past decade, driven by a confluence of factors, mainly our overweights in the private markets. We've been heavy in equities. We've been more U.S.-centric. You want me to use this one now? Good? Okay, so sorry about that. Am I close enough to the mic? Can you hear me okay?
That disappeared altogether.
Just lost the image.
Oh.
All right,
Did the market crash? No, I just
Something like that.
market crash.
Yeah, it crashed.
That's what Black Friday.
All right, we'll go with this. So as I was saying, the strong performance has been.
Come back.
I don't think we have that many more visuals, so we'll try it out. But,
No, it's helpful.
what's that?
It's helpful to have the visuals for the recording as well.
So what we have here is a visual that shows had we just generated returns this past decade in line with the objectives that you set out for us, which is that inflation plus 5% return, the endowment today would be worth $1.9 billion. Had we just invested in a passively diversified mix of stocks and bonds, it would be worth $1.6 billion. But you can see that the endowment today is worth $2.3 billion. And just to put that $700 million difference into context, if you translate that into annual payouts, that's about $30 million more per year that can go to scholarships and fellowships, which we're really proud of. Now, the last page that we have on the performance topic is pure relative data, which I'm somewhat hesitant to put in just because it's not something we ever think about or focus on as we're making decisions. Our portfolio is tailored to our objectives and our specific needs, and that's really our North Star. But what we show here is performance relative to other university endowments and foundations of similar size over the last 1, 3, 5, and 10-year periods. The top part of the gray bar represents the 95th percentile, meaning you outperformed 95% of peers. The bottom gray bar represents the 5th percentile, meaning you underperformed 95% of peers. And what you'll see is that over the medium and long term, our returns are consistently better than 95% of our peers and well into the double digits. I will say back to my Baker versus Vintner metaphor, we were the best performing endowment in the country in 22, and we were one of the worst in 23. And it's not because we baked a great cake in 22 and we baked a horrible one in 23. It's because the liquid strategies that we invest heavily in, that we believe in for the long term, outperformed the public markets significantly in 22, and that reversed in 23. But I would say candidly, I'm neither excessively proud of nor excessively disappointed in returns of each of those respective years. I think they performed in line with our expectations given the market environment, but our focus remains on the long term. But I will say overall, we believe generating these double-digit returns and being in the top few percentile versus many hundreds of our peers is a collective win that we should all be proud of. The board policy gives us the endorsement and the latitude to take risks, and the board members who sit in on our investment committee, currently Regents Hipsch and Wheeler, formerly Regent Mayeron, Regents McMillan and Beeson, they've all been really supportive. And all of this has paid off handsomely for the university, and we're just proud and glad that that'll pay dividends for many years to come. So with that, we're going to transition to the governance model and just talk about some of the overarching principles and practices that govern the activities that I just walked through.
And let me just say before you do that, our intention is to go through the whole presentation here, both on the Endowment 101 and governance, and then we'll open it up for questions on all aspects. Go ahead, Jason.
So before I turn it over to Associate Secretary Laneworthy, we thought it would be helpful just to level set and make sure we're all on the same page about terminology, because a lot of these terms, I think, seem somewhat self-evident in their meaning, but I think it's good just to clarify. And so first, when we talk about ESG, it's really about looking at a more complete and comprehensive view of risks that add in considerations around environmental, social, and governance-related topics. Now, it's been used synonymously with socially responsible investing for some time, It used to be the case that socially responsible investing, or SRI, was more focused on negative screening, or what you don't do. But now it's really been just loosely referred to as any strategy in which you're trying to align your investment portfolio with the mission or values of an institution. Now, divestment and negative screening are very similar in that, as I said earlier, divesting is selling of an asset you currently hold. Negative screening is about putting in protocols to prevent the fund from having exposure to those same companies you might otherwise be divesting from. Positive screening is the opposite of that, where you're proactively sourcing and try to find companies or strategies or asset classes that are deemed best in class. And then lastly, shareholder advocacy or engagement. That's an interesting one because it has a similar aim as divestment, but it takes really the opposite approach. So it says, instead of selling the position, let's hold on to the position and actively engage with management. Let's vote a proxy. Let's put out a shareholder resolution, et cetera. So that's just another tool in the toolkit. But I think it'll be helpful to keep those topics in mind as we go through the rest of the presentation. So with that, I will turn it over to Associate Secretary Laneworthy.
Chair Maron, members of the board, good afternoon. Thank you, Chief Investment Officer Parks, for allowing me to make a cameo appearance to talk about policy and governance, everyone's favorite topics. So over the next few slides, we'll talk about the current structure of governance that oversees the university's endowment fund, how that has evolved over time, both the board's reserved and delegated authority, and then what the two key policies right now that you've already heard a bit about from CIO Parks. We'll highlight those and then go into the discussion of the ESG piece. So the current governance structure certainly has the Board of Regents with the president defining the mission and values of the university, and certainly in consultation with the university community. And you do that through your policies. You do that through things like the system-wide strategic plan. And that then provides this policy framework. And specifically in this instance, we're talking about Board of Regents Policy Endowment Fund and Board of Regents Policy Investment Functions, which we'll talk about here in a few minutes. And that policy framework delegates authority to the president. Much in other areas, and as you just did this spring with the realignment of the approval thresholds in Board of Regents policy, reservation and delegation of authority, there are areas where you reserve authority and there are areas where you delegate authority. And this is an area of your authority that you have delegated broad authority to the president. And the president, as we'll start to walk through then, has delegated throughout the administration. Finally, you maintain oversight, and certainly that's through reporting and having an insight into the university's investments, and we'll talk about the Investment Advisory Committee here in a second. The president then recommends policy changes to the board, approves investment manager recommendations, and that's a key one where that is an authority that you have provided to the president, and it's authority that the president retains. So when CIO Parks and his team want to invest in a new manager, that decision is ultimately the president's. And delegates then authority to the senior vice president. The senior vice president, in turn, oversees the Office of Investments and Banking. CIO Parks reports to the SVP along with the Office of Investment and Banking, and then delegates authority to the Chief Investment Officer and OIB. Finally, then, the Chief Investment Officer and OIB do all of the things that CIO Parks just talked about, right? They implement the university's investment within the board policy framework, within the various goals and objectives that you have set. They make recommendations then up to the president in terms of new manager recommendations, and receive advice and counsel from the Investment Advisory Committee, which you see set off to the side. The Investment Advisory Committee is a committee of volunteers who are financial investment professionals that help to invite and help provide really key guidance to the Office of Investment and Banking. And those individuals are appointed by the president, and traditionally, the chair and vice chair of the board's Finance and Operations Committee, one of them serves as the non-voting chair of the Investment Advisory Committee. So let's talk about the evolution of the governance framework in this area.
The only thing I'll add to that is in the appendix, we did include a much more detailed delegation of responsibility matrix, which you can reference if you want to get a little bit more color on what Jason just outlined.
So before 1991, and this is true of areas of authority for the board maintained quite a bit of authority to itself. So before 1991, the board reserves to itself authority to improve investment transactions recommended with an overall investment framework. The policy framework then includes investment objectives, asset allocation guidelines, and payout rate, the very things that you just heard discussed. And those three components are components that you'll see as a common thread throughout the board's policies as we go through this. It's an area that is reserved to the board, and it's an area where the board then provides guidance to the president and the administration in carrying out these investments. Moving then to 1991, the board adopted Board of Regents policy, investment policy relating to social concerns, and it stated that the university had a responsibility to be socially responsible in its investing. It set up a process where the University Senate Social Concerns Committee was an advisory group to the board, to the president, to the senior vice president at that time to weigh in on investment decisions and how the university should think about social responsibility within those decisions. And when we get to some examples, while it's not clear from the historic record, my guess is that this was set up after the divestment from South African investments, which we'll talk about that in a little bit. Today, I would think about this in the way that the board uses the All University Honors Committee to weigh in on namings and renamings. I would see a very similar parallel there. Moving to 1994, the board then starts to delegate more authority to the president and the administration. So it delegates authority to trade in securities without a threshold. I'll add that because the board wanted a little bit more insight and oversight as they started to delegate more authority, a regent was added as an ex officio to the Asset and Debt Management Advisory Committee, which was the forerunner, which becomes in 1998 to the Investment Advisory Committee and the Debt Management Advisory Committee. So those two were sort of separated in 1998, and then the Investment Advisory Committee was established to provide that investment oversight specifically instead of sort of this commingled committee, and a regent then continuing on as ex officio chair, as I mentioned, and is more advisory than at that point to the president, senior vice president, and the chief investment officer. We turn the century and we go to 2004. Where the board delegates to the president the authority to terminate an engagement with an investment manager or manager without board approval or reporting. So provides that authority to the president. I will just note that there are also a number of amendments on asset allocation guidelines and other pieces that I mentioned before. I didn't sort of provide the complete policy history. I'm happy if any of you would like to talk about that after the meeting. But those are also happening within the background as well, along with some of the liquidity and leverage pieces that are in today's policy, but wanted to hit the highlights. In 2006, the board repealed Board of Regents policy, investment policy regarding social concerns. I'll note that the document materials from the time state that it was at the request of the University Senate Social Concerns Committee and then recommended by the administration. So it was something where the Senate committee asked the administration and the administration then made that recommendation to the board. With that process being removed from board policy at the same time, a guiding principle to consider social responsibility in its investment decisions was added to Board of Regents policy endowment fund. Finally, in 2006, as you start to see the sort of shift in delegated authority, there is more reporting that starts in 2006 that becomes more robust over time, annual reports, quarterly reports, and a requirement that if there are significant changes, that the president let the board know at the next board meeting. In 2011, this is a big moment in this history where the board delegates authority to the president to engage investment advisors and managers. Before this, for the administration to engage either investment advisor or to make the investments that CIO Parks just described, those would come to the board for approval, typically via the consent report in the what was then the finance committee of the board. In 2011, that authority is delegated to the president, and the president then has total ability to make changes to investment managers, to either engage them, remove them, and can do that without board approval, certainly within the guidelines, the asset allocation guidelines, the guiding principles set in board policy, but the president has total authority to do that. Now, if it was a significant shift or it created a issue where you're outside of those asset allocation guidelines, the president would be compelled to report that to the board, certainly. In 2014, added to the annual report are a summary of steps taken to provide opportunities to emerging minority-owned and women-owned investment firms. I'll note in Board of Regents policy investment functions, the encouragement to engage those groups was added to the policy in May of 2010, and then the reporting requirement added, excuse me, in 2014. Then, along with that, was an evolution of investments related to sustainability and renewable energy. And I'll talk more about that when we talk about fossil fuels later in the presentation. In 2018, social responsibility language was modified to consider environmental, social, and governance responsibilities in investment decisions. So that shift then to using ESG and the ESG framework from just social responsibility and this requirement that was put in 2014 around sustainable and renewable energy. Finally, just last June, you amended Board of Regents Policy Endowment Fund to require that the president integrate ESG principles in investment decisions and maintain a statement defining those decisions. If you recall from last year, the discussion was it was important to integrate those principles and to allow the president and certainly the senior vice president and CIO Parks to help define what those principles are. That statement of principles is reported to the board as a part of the annual asset management report each year. There's also a copy in the presentation. So that brings us to today with the two key policies that we wanted to highlight. So that's endowment fund and investment functions. The endowment fund defines those investment objectives, the payout rate, the asset allocations, liquidity ranges, use of leverage, and the ESG guidelines that we just talked about. On the other side, investment functions really talk about the standard of care in terms of the standard of care that the administration should use in assessing and investing. It has that emerging and or minority minority and women-owned managers and the encouragement to use investment managers in that area. And finally, it is where the delegation of authority right now to the president to implement the investments of the university within the framework set up by endowment fund is housed. So all of that authority that you have delegated is in investment functions, and the two then work together as a team to carry out the university's implementation of the endowment fund.
So when we were consulting with various stakeholders over the last couple of years as this endowment fund policy was going through the review process, we used this visual to describe our views on how to most prudently develop and think about a mission-aligned investment framework. And I think as Jason pointed out, the idea being that it's obviously the board's and the president's job to determine the mission and the values of the institution, and it's our job to interpret and execute them. We also acknowledge that there may be other policies that don't directly or explicitly reference the endowment, but which inform our understanding of what it means to incorporate those mission and values. So we've given some examples of our sustainability initiatives or statements on diversity, equity, and inclusion, et cetera. We also pointed out that it's incumbent upon our office to communicate to the board and to the president about what the investment implications might be to adopting different types of frameworks so that everyone is eyes wide open about those trade-offs. So what could help or hinder our ability to meet our return objectives, what could lead to additional costs, et cetera, and we're going to talk about that in a little bit more detail. And one of the ways that we thought to lay out these issues was to think about the mission alignment and ESG integration across this continuum or spectrum that we laid out here. So as it relates to sentiment around ESG or mission-aligned investing, we said you can be antagonistic, you can be agnostic, you can be aware, you can be actively mandated, or you can be aggressively all in. So if you're antagonistic, you're obviously opposed to the idea of incorporating that. If you're agnostic, you're probably indifferent to it. The framework that we've adopted, given your endorsement, is an ESG-aware framework, which embeds ESG considerations into the process and makes it an input to the process. Now, the inflection point between aware and actively mandated is when you're actively mandated, it becomes an output of the process. I think one of the examples that Jason pointed to is in the investment functions policy, where it says that we are encouraged to invest in diversity or diverse managers, emerging, minority, women-owned, et cetera. That's very different than if we're mandated to do that. And so in the aware category, investment criteria remain the primary or the must-have consideration, as opposed to where it's actively mandated, that might become secondary to these ESG criteria. Aggressively all-in frameworks tend to be adopted by private foundations, where their primary drivers to do good and hopefully get their money back in the process. And so when you look at that spectrum, again, we're pretty squarely in the middle in this make money while doing good category. As Jason also pointed out, one of the changes in the recent board policy was that we would develop an ESG policy statement, which I've included here and pulled out some excerpts. So as he said, we integrate, no longer just consider, but integrate ESG. We've been working to implement the phase reduction plan that prior President Gable had directed us towards with respect to fossil fuels. But importantly, when we talk about positive screening, we're also prioritizing allocating into innovative technologies, particularly on the energy transition side, and I'll give some examples of that shortly. On the governance side, we focus a significant amount of attention on diversity of the ownership of the organization, of the board of directors and advisors, et cetera. And then under reporting and disclosure, we've started to produce an ESG dashboard, which initially has been more focused on the fossil fuel exposures, but we've included that for your reference in the appendix. Now, by intent and construct, the board policy and this ESG policy statement, I would say, is more focused on conceptual principles than very specific prescriptions. And so in an effort to make it less conceptual and more concrete, what I wanted to do is describe some examples of what we're doing to align with these policies. So to really incorporate ESG into our investment decision-making and monitoring process. And again, I'll reiterate, we've been doing this for I've been here for about a decade. So I'd say the last 7 or 8 years more in earnest. But when I walked through that process chronology of picking asset classes, picking geographies, strategies, then ultimately managers, when we conduct diligence on a manager, that process takes as short as 4 to 5 months, as long as 2 to 3 years. But we're spending a lot of time with the managers in their office. They come to our office. We talk to the senior people. We talk to the junior people. We're doing deep dive reviews of their past investment activities. We're doing 360-degree reference calls. We're doing legal and operational diligence, obviously background checks, et cetera. And we're reviewing their policies with respect to ESG. So if it's a private manager, obviously we're looking at the types of companies they invest in, but we're looking at what are they doing with the board of directors that they oversee, if assuming it's a control investment, or what are they doing with their policies with respect to sustainability or safety. If it's a public manager, we're looking at what are they doing with engaging their companies? How are they voting their proxies? What metrics do they look at? How do they quantify impact? So these are all the things that we're doing. And the point is to really understand who we're partnering with, understand their mission and values, understand what makes them tick, and make sure that they are aligned with our philosophies. And as Jason was going through the governance process, when we finish that diligence, we put together usually 15-page memos. We have executive summaries that we'll share with our investment advisory committee that ultimately go to the president for approval. So the point being, not only is a lot of work done, but we have a lot of eyes looking at these investments to make sure that we're making sound decisions. And so what I think is relevant is when we're going through that process, what's important to us is that we try to find opportunities to satisfy both investment and ESG criteria. And so here are a couple of examples across each of those criteria. On the environmental side, I mentioned earlier, we've invested in the low carbon ETF for quite a while. Our ESG aware index fund exposure in total today is closer to 150 million. We've invested quite heavily in private strategies that are involved in the energy transition. We did mention in the ESG dashboard that we have 2 exposures to 2 of the largest renewable projects in the country. Collectively, they operate, I think it's 57 gigawatts of wind, solar, and battery assets. We've also invested pretty heavily in carbon credits. which gives us exposure to over 600,000 metric tons, which is 2 years worth of emissions here at the university. That's basically being taken out of the system, but we do that because we like the investment thesis. We also like the sustainability thesis. Under the social side, you'll see some examples of managers we partnered with that in this case are emerging minority and women-owned. But again, we backed them because we believe in their investment thesis and the power that comes from the cognitive diversity and the diversity of those groups and teams. One of those funds I happen to sit on the advisory board for. We mentioned that in the governance section. So collectively, myself and my colleagues sit on 14 different advisory boards, and these are groups that work with our managers to make sure that they're implementing best practices with respect to governance. We look at the proxy voting history before we invest in public funds, really understand the priorities there. And the nice thing about being a small fund like ours is that we don't have to do everything. So it's very easy. When in doubt, we just negative screen something out. So aligned with President Gable's directive, we no longer have been investing in upstream oil and gas. As I mentioned earlier with my metaphors about being a vintner, when we're in private markets, it takes a while for those positions to ultimately liquidate. So we still have some upstream oil and gas exposure. It's quite de minimis, but we have ceased investing new capital in that space. And certainly if we see any situations that might involve labor and human rights practices that are questionable or SEC violations, et cetera, we negative screen them out. And so I think the point is that ESG is embedded in and really touches all four of the corners of our portfolio, and we're proud of our team's efforts in that regard. Now, what I wanted to do on the past slide was really look at some more concrete examples. Now I want to take it back a little bit more conceptual to talk specifically about situations involving divestment. And what this visual is intended to represent is I'd say my de facto understanding of the governance framework and the zone of involvement that my office, the president's office, and the board has as it relates to this issue of divestment. So what I've laid out here is as you go from left to right, you go from the key risks being financial to non-financial. Non-financial in this case including issues that might involve public policy or perception or issues of mission alignment. As you go from the bottom to the top, you go from issues that probably have a high degree of consensus among the board or among stakeholders, and you go from implementation or a means of effect that would be more micro in nature, meaning whether we do a fund or in some instances whether we invest in a specific company, to much more bigger picture. So possibility of blacklisting entire sectors or countries. And so the takeaway here is that our office all day, every day is making decisions that are related to financial risks. And in many cases, these are financial risks where the degree of consensus is quite high. I think everyone would agree we shouldn't invest with funds that are run by people who have committed fraud. We shouldn't invest in companies that are committing, child labor law violations, et cetera. And most of the time, our implementation or our means of effect is we either do or don't do individual funds. And what I would posit is that as we move up and to the right, as we move toward non-financial issues involving public policy, where the degree of consensus might be mixed or low, where, as I said, we might look at blacklisting or in entire sectors or thematics or countries, that's where I would look to the board and to the president for policy guidance. And so, more succinctly, I would say that I don't interpret policy as suggesting, nor do I think it should, that I, as the CIO, should be the moral arbiter of these issues. I think this is the purview of the board. And while I will dutifully manage to whatever paradigm the board deems appropriate, my lane and my zone of involvement in our offices is primarily on the financial side.
And one thing I'll note just on this slide, I think, when we talk about the board's reserved and delegated authority, right? Currently, all of that authority is delegated to the president. But board policy also makes clear that if there are issues that come up that raise unusual, public policy questions, right? It encourages the president then to bring those items to the board. So there's always an opportunity, certainly, for the president to seek your ratification, to seek your counsel on those things, even in an area like this where the president has full authority to make decisions to change the endowment fund, as long as that is within, as we talked about, the asset allocation guidelines and the other provisions of board policy.
So I've talked a bit about what we've been doing to integrate ESG, and now I just want to put those activities into perspective by comparing it to other university endowments and foundations across the country. Again, this is some data points from the NACUBO survey that I mentioned. About 2/3 of higher ed endowments and foundations reported not adopting responsible investing at their institution. Only about 1/4 of them have codified it into their policy. Less than 10% have signed on to a major initiative or commitment regarding sustainable investing, and only 14% do some form of negative screening. Now, if you compare that to what we've done at the university, I've said here dating back to 2011. I think given Jason's narrative, I probably should back that up even further. But the point is, board policy has consistently used language that talks about considering social responsibility. As has been discussed, we've put in language about integrating ESG just recently. And I don't think I mentioned this earlier, but we became signatories to the United Nations Principles on Responsible Investing in 22. We're one of the few university endowments who have done that. And as I mentioned, we utilize negative screening to some degree. And so I think the point is, we are not the first penguins to jump. We're not, the innovators, but we have been early adopters. And I think that the changes we've made, the initiatives we've undertaken, the activities that we've ingrained into our process that I mentioned are certainly meaningful steps in the right direction. Now, as I mentioned, 2/3 of the respondents said that they were not using responsible investing in their process. Then the follow-up question was asked, why? And what you'll see here on the left is the list of the responses that were most common: potential adverse impact on returns, investing mainly in pooled funds, potential conflicts with the mission or fiduciary duty, questions of whether it even aligns with that. Are there funds that have the expertise to do this, and higher fees? And so the list on the right is my attempt to simplify those responses and add a few others that come up frequently in discussions with peers. The first being the question of strategic mission alignment. Whether such activities truly are aligned with the institution's mission and values. Does neutrality at the institutional level better reflect that, or does the issue warrant, in essence, picking a side and potentially disenfranchising a portion of the population? Obviously, I would defer to the board and the president on that issue. To the issue of operational complexity, the second most responded point there about investing mainly via pooled funds. That's what that's referring to, is my comment earlier about direct versus indirect holdings. Pooled funds are indirect holdings where they can't affect the divestment or the specific security level aims. Cost impacts. For us, if we were to shift our portfolio into custom mandates, that would probably add somewhere between $500,000 and $1 million of additional expense in terms of management fees every year. So people tend to get quite worried about the net impact of that to long-term returns. I would say there's also opportunity cost of just the time spent. Right now, the front office investment team that's responsible for the $2.25 billion, the 100+ managers, the 40+ strategies I mentioned, is a team of 4. So deciding what the opportunity cost of focusing on financial versus non-financial issues are is something that comes up a lot. There's also just the issue of headcount. The same survey showed that less than 10% of universities have chief sustainability officers who report directly to the chief investment officer. That tends to be much more common for much larger funds that have larger budgets, but we are seeing that number has started to tick up. But again, that has a cost impact. On the performance side, somewhat intuitively, it's hard to say what the financial impact of non-financial decisions might be, but there's a lot of data we could talk through around how some of these implementation of some ESG frameworks can be negative to returns. To the point of optics versus impact, academic research has pretty clearly shown that when divestment has worked, it's worked as a political and a marketing tool, but it hasn't really worked as a financial tool, meaning to punish companies by increasing their cost of capital. The seminal paper that came out of Stanford and Wharton looked at this and said that to the extent divestment has been tried, it's only raised the cost of capital by 1/100%. And that they estimated you would need to have about 86% of the market follow suit in order for that to increase cost of capital by even 1%. And so the point being, it tends to be a question of, are you really engaged in the topic? Do you want to have impact, or is it much more about messaging? That's directly related to the next point about engagement versus divestment. As I said, a lot of the academic research would suggest that you're more effective if you partner with companies, if you engage with them, if you vote your proxies. If you divest of something, all you're really doing is you're selling your shares in the secondary market. You're not taking money away from that company. You're just giving your shares to someone else who's arguably less concerned about whatever that potential issue might be. And so the debate is really what's going to have the most impact. Another key challenge is the lack of standardization, robustness, or I think logical consistency sometimes with what the criteria are that are used for divestment and negative screening. A couple examples that I'll give. One is the correlation among rating agencies. So S&P, Moody's, Fitch, of the issuers that they rate is 0.99. So you don't have one that thinks the university is AA1 and another that thinks we're junk bond status. In contrast, if you look at the rating agents or the rating services for ESG, depending on the data you look at, they're at best a correlation of 0.3 to each other. At worst, a correlation of 0.3, at best, a correlation of 0.6, which means they can't even agree amongst themselves as to what the good and bad ESG-related companies are. One point I'll make just to underscore this, a year ago, I was at the United Nations Principles for Responsible Investing conference in Tokyo, and I was sitting next to a woman one night who's the chief sustainability officer of a $100+ billion fund. She's got a small army of analysts that help her with this. But she was saying, we were doing a lot of work on our exposure to companies in the battery and EV industry. Great for the E in ESG, right? And she said, what we found is that many of these companies are very vertically integrated in their supply chains, or to the extent they aren't. When they looked at their supply chains, they found that many of them have some of the worst track records with respect to human rights and labor law violations. So she said, great for the E, horrible for the S. Facetiously, what do I do with that? And she didn't have an answer, but the point is it gets to be nuanced. I think the other issue is that we've learned painfully during COVID that global supply chains are very intertwined. And so to disentangle from those and make sure that we're not touching in any way, shape, or form entire sectors, entire thematics, entire countries can be very difficult to do with any real logical consistency. There are federal and state legal considerations to take into account. As you probably know, ESG has become a bit of a political hot button. Some states have actually implemented anti-ESG regulations. There are specific issues that I would defer to my colleagues in the General Counsel's office to speak to about our state, but that's a factor that comes up frequently. And lastly, there's obviously reputational risk. I'll just speak to that from the seat that I sit in. There have been a lot of situations where in our world, I guess the way I describe it is both sides have to turn their key, meaning if we want to invest with a manager, they have to want to have us as a partner. So we have to turn our key, they have to turn theirs. And we've heard many stories of folks who have heard from their investment manager partners that they are going to cease being their partners if they've taken certain stances on certain issues. And so it can have trickle-down effects, certainly to us. So I think that the takeaway from this is that it's complicated. And again, I think there aren't solutions. There are just trade-offs, but I just wanted the board to feel like they had a good sense of what some of those trade-offs were and some of the complexities.
So we'll conclude the presentation with a look back at board and administrative actions where mission-aligned investing criteria, today ESG, has been used. So we'll start in 1979 to 1994 with South Africa. So in 1979, the board considered initially a resolution to fully divest from South Africa. The board did not approve that resolution at that time, but directed the administration to create a plan to address the issues that have been raised by the university community around investing within South Africa due to apartheid. The board then, throughout the next few years, moved to prohibit future investments in South Africa in '82. Then companies that were not signatories of the Sullivan Principles, and the Sullivan Principles were principles that demanded signatories to provide equal treatment of employees regardless of their race, both within and outside of the workplace. Then, and that was in 1983, then selective divestment of companies in June of '85, again using the Sullivan Principles as a test. And finally, full divestment was approved by the Board of Regents in October of 1985. That was all contingent then upon free elections. So once free elections happened in South Africa, those restrictions were removed in 1994. In 1998, in Burma or Myanmar, the board adopted a resolution to ban investment in Total Oil Company. So Total Oil Company was a company that was doing business there that members of the university community felt was not ethical in their process. And so the university actually divested its Total Oil shares at 1.2 million in March of 1998. The University Senate, though, still took action in May of 1998 to asked the board to ensure that the university did not continue investments with Total Oil after the fact, even though the university had already divested. And so the board agreed to that and approved an action to direct the administration to avoid any future investments in Total Oil until it suspended its operations in Burma, Myanmar. Both of those examples are certainly within that era. If you reflect back to the evolution of governance, where the board had a lot of authority reserved to itself. And so the board was the one making those decisions. As that starts to shift, our other two examples are in eras where the administration had additional authority. So in Sudan, this was the first process where a concern was raised by the university community after the repeal of Board of Regents policy, investment policy relating to social concerns. That was that policy that created the structure where the University Senate Social Concerns Committee would weigh in. So this was the first one outside of that. So the request was directed to the administration. And at the request of the University Senate, the administration agreed to prohibit any direct investment while advocating with fund managers in commingled funds to avoid investing in Sudan and coordinate that action with other investors in those funds. So given all of those actions taken by the administration were areas that were delegated to the administration, the board did not act. The board did not comment. We don't see any record within the board's records of doing that. This all happened within the University Senate. Finally, turning to fossil fuels, so the 2014-18, those are the reporting requirements that I talked about earlier. Then turning to 2021, then President Gabel directed, because again, she had full authority to do so, directed the administration to stop any direct investments in the carbon 200 companies and no new private investments in funds that invest primarily in fossil fuel extraction or processing. She also then directed that a full exit from current investments in those areas was to happen and was estimated to take 5 to 7 years when that directive was issued in 21. And then finally, in 2023, as we've already discussed, the board then requires integration of ESG principles and a statement outlining those principles. And so with that, Chair Mayron, members of the board, we would be happy to engage in any questions or discussion that you would like to have.
First of all, thank you for what I think I found to be an incredible presentation in a very complex, complicated area in a way that I could understand it, and I don't have the kind of business background that others may have around the table here, so I really appreciate that. I do have one question that I want to ask, and then we'll open it up to, right now a couple regions have indicated they have questions, and that is, this goes to you, Jason, in terms of the decisions that were made. How was it determined that there was consensus on a particular social or political issue? Andrew put up the chart about, where there's complete consensus on a particular issue. For example, we don't want to invest in companies where the CEOs engage in fraud or something like that. To others where it's low or mixed, how was a determination made that across the university community there was consensus on on the issues that we did take a stand in, either the administration did or the board did, if you know?
So Chair Mayron, looking at the historic record, what I would say is all 4 of these examples were examples that came through shared governance or were advocated for on behalf of the university community, and then where there was agreement. So the first 3 certainly, I believe there were certainly other actions on fossil fuels that have gone through various Senate committees. So I think all of these actions were actions that were discussed within shared governance there was a consensus there, and then, an appeal either to the board or to the president on these items.
All right, other questions? Regent Verheulen.
Thank you, Chair Miron. And do you prefer CIO Parks or Andrew?
Andrew's fine.
Okay. I have a few questions on slide 8, which is page 11 in our materials. Slide 8 is the sources, types, uses. Yeah, that one.
The pretty one.
The pretty one. It looks great in our materials. So I have a couple questions on some of the items on here. First of all, under the sources, it says that state appropriations, tuition, and other miscellaneous sources cannot fund an endowment. Is that an investment principle, or is that a university policy?
Thank you, Regent Verheulen. So for the specificity of that, I would probably have to defer to my colleagues, either Mike Volner or Julie Tonneson, on some of the specific policy implications. Obviously, our job is, once the money is in, is to manage it. So I think there's a litany of different rules that are involved. One of those policies is governed by our office, but I would say that that's more administrative. So I can state that is a factual statement. Beyond that, the why behind the what and the whole history of it is something that I would not be expert on.
Okay, but just to confirm, tuition dollars do not go into the endowment fund directly.
Tuition dollars cannot be used to fund an endowment, correct?
And then I noticed that this says donors 26% pre-1962. What's the uniqueness of that 1962 number?
So that was when the foundation was incepted. And so that was basically the inflection point where everything prior to that came in from donors went directly to the fund that we were speaking about today. The separate legal entity, which being UMF, got all of that money post 1962. Okay. So that's the relevance of that time frame. Okay,
I just for clarity's sake, wanted to draw some of those distinctions. And then the permanent university fund is 41% of the sources. What determines what amount goes into the endowment versus what goes to the others? Is it really just after operating through the Minnesota statute, what's left of that is discretionary on where it goes, or is there kind of a number or percentage that?
Apologetically, that's beyond the scope of my expertise. I do know that there are state laws that detail all of that, exactly what comes in and when and how it gets divvied up. I do know, I reviewed a little bit of that in anticipation of this, but not to a degree where I could give a good job responding to it. So I'd be happy to follow up after with some more detail.
I would appreciate that. Mr. Volna, if you would like to as well. In reading through the statute, it seems like it's prescriptive, but I'd love the answer, since you so energetically ran up here to answer it.
Here on Regent Verheulen, yes, there are state statutes that specifically define what types of funds, what types of monies are sent to the university for different types of activities. So mining royalties, lumber, timber management, all those kinds of things are defined. There's a process the state goes through. They manage those permanent university funds. They generate the revenue, and then about a year later, they transfer those monies to us. And where we put them in PUF, which scholarship fund and so forth, is also defined in state statute.
Okay. And this is maybe not even a question for any of you sitting in front of us. It might actually be a question for my colleague. My understanding is that the PUF funds are coming from lands that are owned by the state of Minnesota or otherwise managed by the DNR relating to mineral rights, timber rights, but these are the lands from which Native Americans were excluded under some of the prior treaties and the founding of our state. Am I misunderstanding that, or?
Are you asking me?
I am.
I just want to say Cody stole all my questions.
I'm sorry. Well, I'm giving you a chance to talk.
Do you have a response?
Chair Maron, Regent Johnson, and Regent Verheulen, there would clearly be a connection between what happened way back when and how those funds and lands became part of the Permanent University Fund, I don't have a good history of it, but there would clearly, I think, be a connection.
Regent Johnson.
Thank
Ed
you.
Johnson.
My list, next on the list anyway,
All right,
so,
yeah.
thank you. Yeah, I think Regent Verhalen and I both got stuck on the same section and then the same box. My understanding was, so the university was founded in 1851. It was kind of going broke by the time the Morrill Act came around in 1862. And under the Morrill Act, it was shortly after the Dakota War, or around the same time, and the Dakota were, by order of Governor Ramsey, ordered to be exiled or exterminated. So most of them got kicked out of Minnesota, and their lands got sold pursuant to the Morrill Act. And besides the University of Minnesota, 35 other universities got their land grant endowment from the lands in Minnesota. So Governor Ramsey referred to that as the Minnesota windfall. And I'm guessing when we talk about land grants in the corner there, that is the cornerstone. Also, just from my part of the state, I see where, and this is probably in a statute someplace, but we get iron ore mine taxes. Is that a tax on all minerals or and lumber and timber? And I'm curious now, because now that part of the state is toying with the idea of getting into the copper nickel business. And is there a general statute in place for dealing with extractive industries, and the University of Minnesota might get a piece of each of those? And if you can't answer today, maybe it's a question for the future.
Go ahead, Mr.
Thank you, Regent, or Chair Maron and Regent Johnson. Generally, the revenues that come to the university are derived from the PUF funds. And there are many different things that can happen, and I would say it's probably beyond the scope of this discussion, all the different types of revenue-generating activities that the state might conduct, but it is generally revenues derived from those PUF lands.
Okay. Thank you.
Okay. Other questions for our regents? All right. Regent Kenyanya. I think is that what you're doing?
I thought I had more time.
You can take your time.
Yeah, I don't think I can. Thank you, Madam Chair, Mr. Parks, Mr. Langworthy, for the discussion. I think on that last discussion, Chancellor McMillan was just trying to contain himself. I'm sure he had something to say back there.
Tecumite.
Yeah, right. But with that, so Mr. Langworthy, I mean, the last kind of step on that board policy governance framework evolution was last year, with the, I guess, the direction to consider ESG, and that's a pretty loose direct. I mean, the way that's framed is here's the mandate, but you obviously know how to incorporate that and you know can respond to that. What does a similar approach look like to something more specific, right? Because I think what Mr. Parks, what you've walked us through, obviously, you know, very helpful, very, very educational. I think the summary is it's complicated, and there's a lot of consequences. There's ones we can predict, and there's ones we certainly can't, right? And if when I look at the evolution, you know, from pre-1991 to last year, what I'm assuming is that this kind of transfer of delegation is in recognition of how responsive you have to be. I mean, how ineffective would it be if you had to wait till next month to come present a fund, you know, or whatever, and as things move. So that's what I'm seeing there. Is it possible to implement, you know, some of the things that we may be considering as a board or that the campus community may be discussing, but frame them in a similar way where the directive is, we want this kept top of mind. How exactly you do that is a little more open.
Yeah, thank you, Regent Kenyanya. So a couple thoughts I have. First is, I think the change in the policy language from the prior amended version and the version that was amended in 23 switch, the key verbiage change was a switch from consider to integrate ESG.
Yeah.
And one could argue that you could consider but ignore, which was the framework before. We moved into something that has a little bit more teeth to it, which is we have to integrate. Now, as I said earlier, candidly, it was a codification of something that we had already been doing anyways, which was integrating into our policy. But I think you touch on a key issue, which is that it highlights the challenge of, and I'm not a policy expert, but if I speak in generalities, policies at a board level are intended to describe first principles viewpoints and then give delegation down to folks like myself or others in other positions to implement. The challenge of this is so many of these issues come up very bottoms up, where it's a one-off issue. It's something that you have to address, and it's very hard to put into policy overarching governing principles that can then be applied across all these situations. Because I could rattle off 30 examples of something where I'm sure there would not be consensus, certainly in this room among other stakeholders. And as I said earlier, for those situations, I would argue that it's not the CIO's position to be, the moral arbiter of it. So I think you're touching on what is a key challenge of how do you actually define at a board level mission and values and the extent to which that gets aligned into an investment framework in a way that gives us clear marching orders. I think your summary statement of it's complicated is the right one, because it isn't black and white. We are trying to kind of cobble together that mosaic, as I said, of different considerations to try to understand that. I think the last thing I'll say is that the key distinction, which I touched on the spectrum or the continuum, is when we switch from endorsements to mandates. And I think that's where it gets more complicated, where if it's not just consider this, factor it in, and show us how you're doing it, which is the current philosophy effectively, to we want to mandate this, don't do this, or make sure you get X amount of this in the portfolio, that's a very different paradigm. And so I think that's just a key challenge that I would suggest the board keep in mind.
And Chair Maron, Regent Kenyanya, the thing I'll add to that is, if you look across the spectrum of your board policies, right, there are policies that are very broad that establish guiding principles and then give a lot of latitude to the administration to define, those things administratively. Then there are other policies where you are very direct and you are very prescriptive about what you want to do and how you want the administration to do it. And I think the balance there within policy is where do you want to land? How much do you want to provide to the administration in terms of guiding principles or very specific direct mandates? And the other thing, I think it's a good point as well, the evolution, and I forgot to mention this, as you look at that evolution, it's also the fact that the university then establishes the Office of Investment Banking. It establishes the role of the chief investment officer. So there's a transition as well from using more outside support to having more internal support and expertise and professionals that are doing this as well. And so that's part of that is that evolution. So then it just depends on where you want to land. Do you want to be more prescriptive, or do you want to sort of set the guardrails and then allow the administration to figure it out from there?
Madam Chair.
Follow-up question?
Yeah, no, not a follow-up, but that makes total sense. And just one of the last words you used, Mr. Langworthy, guardrails. I think that's probably the more appropriate end of the spectrum to land on here. Another thing to consider is, there was that Senate committee, and I haven't had too much time to really pull my thoughts around this, but what is the role of the university community in that, especially in a way that is consistent and predictable rather than kind of the one-offs you refer. There's not a lot of predictability in your world, so any that we can kind of offer you would probably be helpful. But thank you.
Yep.
If I could just respond briefly. Thank you, Regent Kenyanya. So there is the Social Concerns Committee that still exists. Our office has not met with them since 2017, and part of the reason for that is that in their charter, I don't know if that's too proper of a term, but basically their mandate, as I've read it, the only thing that references the activities of our office relates to voting proxies, which I think, I wouldn't say it's antiquated, but it was much more common when organizations like ours would have direct holdings. As I mentioned earlier, 1.7% of our portfolio is directly held. The rest is in funds for which we aren't voting those proxies directly. So it never really made sense to engage them in earnest. And I think they felt the same way because there wasn't enough substance to it. I think looking at over the last couple of months at what many peer institutions have done, I think they've broadened out the scope of what social concerns committees like that, they might be called different names, but effectively what they might look at as it relates to the investing activities. And I think that certainly could be something worth considering.
Okay, with that, we're going to conclude our work session. Thank you so much for the presentation. We're going to adjourn for 15 minutes, and then we will start the mission fulfillment activities. Thank you.